Welcome at forextrading.com. Let's talk about how to assign a stop loss to our entry market position. Well, stop loss is our backup plan. So in case of market going different direction that we predicted that we have entered the market, we want to our transactions be closed at a specific point. So stop loss should be as short as possible and as wide as it has to be in order not to activate our stop loss without a particular specific reason. So for example, we are looking at 30-minute chart. Let's zoom in a little bit. The prices started to accelerate to the upside, so we would be interested in going long. So let's say after breaking out from this rectangle beautiful pattern, let's say somewhere at this point we enter the market. So our stop loss probably would be somewhere just below those candles, those recent candles, or just below this rectangle pattern. So I would assign the stop loss to be just below this rectangle level that we can mark as well as a line. So stop loss would be just few points below that level. Market can very often move into a different or random direction in some specific time we are looking at. For example, in next 15 to 45 minutes, market could back a little bit to this comfortable zone or move back to the end of this rectangle pattern just to test this level and to move up again. So we don't want those moves to clean us out. I mean, activate our stop loss when the market is moving against us, but only for a few minutes. Also, stop loss should be cooperative with our profit. So if we are taking, let's say, about 55 pips of stop loss, we are aiming in 100 or 150 pips profit. That's the ratio in the strategy, which is very useful in order to profit from the markets in long distance. So let's take a look at some another examples where it is even more reasonable than this recent example to enter the market when the market is narrowing down to some points, like for example this triangle, this beautiful triangle, and this pattern tells us that market can break out, and if we enter a transaction somewhere around here after this breakout, we could give ourselves opportunity to enter the market with some kind of short stop loss. Let's say first stop loss, the short one could be just below this candle, or if we want to be very sure mature stop loss, that we are very firm sure about this transaction going long, we can give ourselves the space to the stop loss can be longer in this case. So usually I'm showing couple of options, two options we are having by placing stop loss very aggressively just below some level or some close point when our entry market occur, or when we are very sure of this transaction going long, it is more advisable to leave the stop loss a little bit lower, a little bit more wide stop loss in order the market when it's coming back to a comfortable zone, and not to clean us out with this stop loss placed just below some recent candles. So you see, when placing the stop loss, there is always a rule involved that we are looking at some kind of pattern, or we are looking at support resistance lines. So our stop loss in this case, looking at support resistance, could be as well here, or it could be a little bit lower, just below recent important support resistance, which is 31.25 in this case. So I believe, and it is an example of placing a stop loss by a support resistance line, an important pattern. So the market is showing us what kind of behavior we can expect. I mean, how deep the market, after breaking out from this triangle, can break out to the upside and come back, at what support resistance it shouldn't be moving downwards. So we are thinking about predicting a comfortable zone for the coming back option. And if we want to be in this transaction still, if the market's coming back here to this zone, if we want to be still in this long trade, most of the time it won't be comfortable for us, so the stop loss could be a little bit higher, like this one. But it's very often happening that the market is coming back to some less important support resistance, like this last red line, and it's coming back from this line again to the long side of the trade to make long profits in the long run. So that's how it's happening. Very often the short stop losses are cleaned out in order to market come back to its recent trend. So it is very important to trade with the trending, and that's what I'm talking about most of the time. It is connected with stop loss and limit option in order to profit. So these simple rules apply to each time frame, each different time frame and different instruments. So you can work those rules at different currency pairs, different commodities and so on so on. This way of placing stop loss I would call a logic use of the stop loss, because it uses the recent market behavior and our logic experience with instrument like this main currency pair at 30-minute chart to place a stop loss to minimize the probability of the market going to this level, or to make it otherwise saying as wide as necessary in order to catch as far probability of market going in direction when we entered the market, I mean long position. So let's take a look at some other example of stop loss behavior at the live chart. For example, some situations are very firm and interesting because there are moments when our stop loss have to be 30-50 pips at 30-minute chart, and there are also moments when we are entering the market and the stop loss doesn't have to be necessary as wide as I've noticed and I showed you before. So here, for example, after entering the market somewhere around here, after breaking out to the downside, going short position, our stop loss could be somewhere around 27-30 point. So sometimes we can really make it happen. I mean, make stop loss really short as possible, and with using our logic and market behavior at the recent situation price chart. So let's take a look about some other examples of market breaking out or going short. For example, this one right here, we see a retracement wave. We can see it like here, like kind of flag after a market came back to the short side, I mean to going down suddenly and entering, for example, somewhere at this point could be very interesting, and our stop loss would be placed just above recent candle. This would be the shorter stop loss I was talking about before, or our stop loss, more reasonable, could be placed just above this pattern, or somewhere, even somewhere around here. See the support resistance here at the upside really tells us this is the upside of this pattern, and we can use the stop loss as far as possible as well to make this transaction happen in case of going short rapidly. But most likely, most of the time, I will be showing that this wide stop loss isn't really necessary when the market, when we are choosing the opportunity to enter the market, like here for example, we are so sure enough that market is going down for few moments or few hours, doesn't really matter in this case, that our stop loss doesn't have to be that long. So we are using some kind of particular behavior. That's what I'm really teaching, to find those behaviors when we are not really that much concerned with a stop loss. Of course, we are setting up a stop loss, but this is not our main concern. We are already concerned about our future limits and how much we will profit and when we will get out from transaction with the profit. Let's look for some other and nice, beautiful examples when the stop loss was used. Let's go, for example, to 4-hour chart. Let's clean it out a little bit. And right now we are looking at current euro dollar situation at 4-hour chart. Let's zoom it in a little bit to show you more clear how we can use the market using the stop loss. And right now we are looking at the situation when the trend was an uptrend, so medium or big trend was an uptrend at 4-hour chart, and we are looking for a possibility to enter the market in medium term to grow with the market. So you see some situations showed us there are a great demand at the market. It is growing rapidly, and at some points market consolidating, making those rectangles or triangles, and we could search for those possibilities to enter the market with the long position, like here for example. Then our stop loss should be something just above those recent candles, like I've a point before, that it would be our shorter stop loss, a little bit wider at support resistance line, which is also just above overall this pattern of rectangle. You see this rectangle, end of rectangle, a base of the rectangle is also some kind of support resistance at this moment of euro dollar 4-hour chart. So the method I'm showing you how to place the stop loss is based on behavior of the market, behavior of instruments I know, for example, and the logic thinking or logic behavior of the market, that it shouldn't really be coming down below this line, this support resistance, because recently it didn't want to, and we are having an uptrend, so we are having much more probability of market going in a still in an uptrend instead of breaking out from this support resistance line, which is base of this small rectangle at the price chart. So this method is using patterns and support resistance, which you see a base of the pattern is usually a support resistance line itself. So these two things are combined, or we could say they're almost the same. Another way to place a stop loss is, for example, if we are having some kind of trading strategy that really tells us we want to take 100 or 150 points from the market, then our stop loss should be somewhere around 50 points. So for example, entering the market here, we know our maximum stop loss should be around 50 points, and that's what we are managing. So our maximum stop loss in this moment, looking at this chart, entering market this position, 50 points is somewhere just below this recent candle, and that's all that we can really afford to place our bet at the market. So this kind of method I would call the out of the touch with the market method. So we are not really looking at the price behavior pattern support resistance. We are looking only at the situation of our account, how much we can afford to lose, and based on that information we are trying to place the stop loss as the best way we can. And this second method is really, I wouldn't recommend at the live market, although you can really try to teach yourself to train at a demonstration account with your training account profits. It is always most reasonable to adjust your profit and stop loss amount of pips to recent situation at the live price chart. I mean, if it's 20 points, you can take the risk to be reasonable at the market. That's great. But when it's 50 points that you can really sacrifice as a potential stop loss, and there's more at the market, that market came really back to some levels below this 55 points you can sacrifice, then really you should take, for example, 95 points that you can afford. You have to think about widening your spreading your stop loss, or take the smaller position at the market to make the stop loss affordable, because it's really about logic, behaving of the market, probability, and the stop loss have to be placed in order to maximize your future profit and minimize the situation when the market come back just a little bit after some not important level, and clean your stop loss out, and then come back to a trend which is growing based on your analysis. So that's pretty much it for today. You can watch more stop loss examples in our live trade example menu, and there are some also more advanced techniques I'm discussing at online training program courses. Thank you very much for watching.